Welcome to the Weekly Notebook Review. I am Robert McGroarty. This podcast takes on a bit of a different format where we are live each week on Twitter Spaces. I crack open my notebook and review Hedgeye research with anyone who wants to learn a better way to invest. We feature both Hedgeye power users as well as some special guests that might pop in. If you want to learn more about our research, visit hedgeye.com. If you'd like to participate in the live stream, follow me on Twitter at HedgeyeRJM. Now, let's review the data. Welcome to another episode of Weekly Notebook Review. So here we go. It is March 1st, the first day of March, midweek, last month of the quarter. It's been an interesting year to date. We've had some ups, we've had some downs. The Bears are back. As I said, the Thunder Bay Bear certainly he's snoozing in that green eye, red eye app, but who knows how that bear will come out of hibernation tomorrow. And we certainly had sign of some dichotomy out there in the markets with energy leading the charge in regards to U.S. sectors that were up almost 2%, versus conversely Utes and REITs down about 1.5%. So interesting kind of dichotomy. A few things were flat. S&P certainly kind of had some intraday moves, but at the end of the day, the kind of economic data is certainly taking hold, and bad news is bad news. It's really what we've been talking about. Since February, like at least late January, but probably all of February. I felt like a bit of a broken record on many of these notebook reviews. So glad to kind of see the underlying equities and underlying securities actually take hold. A lot to talk about today, though. Hey, Mitchell, we got a lot of big higher lows, certainly in the longer end of the curve, and that 30-year and 10-year. We've got some interesting things happening in regards to overseas, Europe in particular, some lower highs there. So lots to run through. Excited to be here on this amazing Wednesday afternoon, coming to you live from the Stanford office. I was on an early train this morning. I texted you, Mitchell, that I was very perplexed. There were two gentlemen on the train, everyone out there, and one was watching The Affair on Showtime, and the other one was playing a Nintendo Switch. And my brain was having a really, really bloody hard time comprehending how you would do either of those things, not only just before 7 a.m. on just any given day, but certainly 7 a.m. or before 7 a.m. on a Wednesday, so Wednesday morning. But hey, to each their own. That's what makes this.
It amazes me what people do with their free time.
Yeah, it's like, I guess this is what makes.
It just seems like such a waste of time.
Yeah, I guess it's what makes the world go around, right, Mitchell? But certainly, yeah. I was befuddled. I was certainly befuddled. When the guy pulled out the Switch, I literally was like, what the fuck? You're like 48 years old. Which I guess really, the age doesn't really matter, because I know there's a lot of gamers out there. Me personally, I'm not one of them. I absolutely suck at gaming. But I know it brings a lot of people joy and all that kind of thing. It was just a very odd dynamic. It's like an early-ass morning train going from Boston, through New York down to D.C., and yeah, anyway, we'll fucking stop talking about this subject because it's a waste of time.
I am 48 years old, and you will never find me pull out a Switch unless I'm handing it to my 8-year-old, and she only has a set allotted time with that Switch.
Yeah.
So
the
irony of today going to the Bears is the vast majority of longs in my account were up. So
isn't that a bitch when you make money on both sides of the book, bud?
MLCO, EDU, FNV, KWeb I still have, Gold, ITA, GLD, HCA. So I bought more dollars today. I actually shorted a little more oil today. If I remember correctly, oil was 77.05 in 77.91 was the top end of the range, and I saw it get close. I think it was 77.65. Did I see it?
I got it.
So I think I
don't know where it closed. My number's still ticking, so I don't know where they actually officially closed it. But I got 77.68 on the screen right now. So yeah, it was.
Yeah, I shorted a little more when it was at 77.65. Yeah. So I 30 cents away from the top end of the range. I did it incrementally, so if it moves a little higher, I've got more room to get bigger. But yeah, I just like you said, the macro is trading more like Quad4. China is trading like good accelerating data, not good, but accelerating data, where the US is seeing decelerating data. It's nothing that Coach didn't say on the macro show today, and most of us probably didn't notice in our notebooks this morning. Well, the past handful of weeks of things that have started, but I still am. I was texting you guys behind the scenes. And I'm not questioning it. I'm still perplexed by the IIGD. I don't understand that one, but at the same time, I'm sure it would fall back to the signal and something that I'm not seeing. Because if bond yields keep moving higher, especially in the short end being pushed up, I would think that even short term quality credit would yields would move higher and prices would move down, would be my thought. But there's probably something there that I'm not seeing. I when I don't understand something, I just stay away from it. So I don't own any of that, but I just don't get that one. But outside of that, I shorted more high yield yesterday, so that was up today. So that was nice as well. The one that I'm getting, the few shorts that I'm getting hit on, I guess, would be small cap.
Yeah.
So
That was
I'm
a circle in the book this morning, that's for sure. Yeah, that risk range.
Small
On the
cap
Russell.
to me is funny because the small cap to me is funny because they're the shittiest of shitty companies, and they will get smoked when the credit rolls, when the small little, well, not small little, when the group of 40% of all these companies out there who don't make money in small cap land, when that credit starts to roll, when you start to see more subprime auto lenders, like the one we saw on Friday go under, as the more small caps go, the more the Russell will get hammered. But the dynamic now is more so short cover rallies. Still I'm jumping into these things. So that one is still, to me, probably one of the eyeballs that's or one of the bullseyes that's sticking out to make the most. It's just more so of when, right?
Yeah, so on the Russell, I've said this a number of times on Weekly Notebook Review, and I'm going to repeat it again. I think this is where, from reviewing the risk ranges, looking at it both on a day-over-day and a week-over-week basis can really help in terms of some kind of like executing in the immediate term for the longer term. And on a day-over-day basis, the Russell was circled because it was a higher low and a higher high. So that's what the
Yep.
day-over-day risk range was telling you. But on a week-over-week, you had you would have a slightly higher low at 1859 versus 1857 last week, but a big lower high at 1939 versus 1958 last week. So that, again, when you see those lower highs being put in on a week-over-week, or more like kind of a bit more of a trending basis, on a more of a week-over-week basis, then that kind of gives you a bit more clarity as to like what's really transpiring, and to sort of maybe erase a bit of the noise or the Brownian motion that's happening on a day-over-day basis. And again, that signal isn't necessarily saying go away or don't play there, but certainly, again, the way that I read that is, just let it breathe a little bit, right? Let it kind of maybe confirm on a more immediate term, aka day-over-day basis, a couple of those like lower highs, and then get kind of a bit more aggressive with not aggressive, but then kind of execute, be a bit more comfortable executing in that environment. I mean, the good news is that if you're looking at kind of the trailing the risk range versus where prices come, the top end of the risk range is not even close to recent highs, and certainly not on a 1 or 3 month basis, which are back on basically, what was that, February 2nd, February 2nd, where we put in 2001 on the Russell, and even on an immediate term basis, sort of like that 10 and 15 day window, your look backs are closer to where was it, by basically February 15th, which we had kind of around 1960. So with the top end of the range at 1939, not even close to recent highs. So that really just signals, consistent lower highs moving forward. And that's exactly, in a bearish formation, that's exactly where you fucking hammer it home, and you buy more SRTY if you can in the old triple 3X DGen account.
Yeah, so it's kind of funny because I know Keith hammers at home, and rightfully so. The moves on the upside and downside in the Russell are, in my opinion, I think it's more fact than anything, but is due to the lack of liquidity in markets. So whether it's lack of liquidity on the upside or downside, that's what promotes these large moves. So when you have short cover rallies, it doesn't take much to get them exponentially higher. And when people need out altogether, it doesn't take much to get them pounded, right? Yeah. So if I learned anything back in 2008 and 2009, I was on the institutional trading desk dealing with small and mid cap thrifts. And we had names that, traded maybe, we had names that traded by appointment, but you also had names that traded a couple 100,000 shares in a day. And you had institutions with hundreds of thousands of these shares, and they needed out. They didn't just want out, but they needed out. And when you need out on something that just outright doesn't trade, it'll trade at a price. Oh, yeah. It's where is that price, right? So, when you've got guys saying I've got 100,000 for sale, and the thing trades 10,000 shares a day, you're like, okay, where, right? So, small caps will get it. Small caps, if in the event of a credit crunch or credit crisis that most of us believe is on the horizon, whether you listen to Hedgeye or do your own work, whatever. I'm of the opinion a credit crisis is out there. Lack of liquidity in the system is going to perpetuate the small caps getting absolutely hammered. Right now, it's just a function of risk managing everyday price action. But in the next 2 to 3 months, this one I think we'll be talking about saying what'd you do on such and such a date.
Yeah, I mean, from a small cap standpoint, if you look at the IWM, we're about a little over 11% from kind of current-ish pricing to the top, to near the top, or we'll just round off, and even 10% to the tops heading into like early 2020, aka late 2019, and we're about 45% if we retrace all the way to the bottoms of like COVID lows. So, that gives you kind of an idea, where we could go. But at the same time, we measure and map price volume volatility. That volatility of RVX closed around it came in closed around 2450, and it's been on a month over month basis. It is positive, so it's plus as of this morning plus 173.11. Yeah, exactly. So it's. I'm with you. Yeah. So again, that vol, but on top of that, though, the volume really isn't supporting these moves and positive moves, but there's also not a ton of conviction yet. There's been some conviction on the down moves. Never mind. So there's a bit more, there's a bit more volume on the down days than there are on the up days. So to your point about volume and liquidity, I think also a telling measure there. So if we do get some of this vol, Keith has been alluding to it last few days, really since Friday, about the vol starting to really build and to kind of imply that these volatility ranges are kind of moving to the upside. And you mentioned VIX in particular this morning, and how the top end was really starting to near and move up towards, it had been 28, 29. Now it's like really creeping up into the F bucket of north of 30. So it'll be interesting kind of to see how that plays out, right? The VIX kind of closed around 26.5. So still pretty squarely inside the chop bucket, kind of the top half of that. But I think as I just said, that vol of vol component, which there's a clip that I found, or that Genron actually sent me from a number of years ago on vol of vol, and I'm going to have that on a beginner's guide on Friday. I'm going to have that as one of the clips. I think it's a really important kind of review from Keith on a macro show back in March of 2020 on kind of how to think about vol of vol and how that impacts trending volatility or non-trending volatility. So
yeah. I mean, to your point on VIX, it's building, what I guess what chartists would call a base. But I mean, it's still, if you look last Friday, it was, your low end of the range was 1926. Today, still 1932, even though it's lower than 1960. It wasn't more than last Wednesday, or I'm sorry, on the 22nd, where the low end of the VIX risk range was 1831,
Yep.
right?
Yep.
1803 on Tuesday. So on Tuesday, the 21st or whatever,
Yep.
2002 on 19th. I
Yep.
mean, it's just building. And as we know, nothing really goes straight up forever.
Yeah, but
Or nothing goes straight up. They're always ebbs and flows.
correct. But I think that higher low is really telling. And again, this is where kind of from it's not really front running the signal. It's just sort of being aware of the signal and what where the probabilistic ranges are, right? In terms of on a week over week basis, that VIX is a huge one. And again, a good example of day over day, was a lower low at 19.51 today, but but a higher high at 23.99. Versus on a week over week basis, that's 18, as you just said, 18.31 on the low end. So that's almost it's over a dollar or $1.20 basically move higher on the VIX. And
that's
again,
big.
and a big and is so again, so that's just probabilistically, that's implying that the math says that we really don't move lower than that number. Now again, price moves and does its thing, but that from a trending volatility standpoint, that trend is certainly going in the upwards, up. It's going up and to the right on the chart versus kind of where it's been, which is down and or sideways for the last really three months, kind of between that 18 and 20 or 18 and 23 band. So very very interesting stuff there on the volatility front. What?
Yeah, I can't argue.
Yeah. Where? So you said you were adding a little bit of dollar, Mitchell.
Mm-hmm.
Keith did so as well this morning in the re-rank product for Macro Pro subs. Where what may I ask? Kind of sizing by out of curiosity on the dollar. I mean, where? And I don't need specific, but it's just sort of in your range of kind of mid maxes. Like, where are you living right now? Kind of on dollar exposure, out of curiosity.
I'll give you levels. I think. Hold on. I have a couple models, but I'm at like 5.5.
Yeah.
I'm at 6 in 2 models, and I'm at 5.5 in 1. I reduced a little bit of gold exposure, but I'm still at about 5. So one model I'm 5.5, and the other model I'm 4.5 on dollar to gold.
Gotcha.
So
be kind of like
dollar
a little bit above mid, but not quite mid levels, basically.
Well, dollar I can go up to 12, right? So I'm a little bit below mid on, and then gold I'll go up to 10, 12 as well if I decide to get big. So I'm just a hair below mid, and I want to see gold with more than a couple up days before I start to get really sized in there. I'd love to see the long end of the curve start to move down a little bit, and I think we could really have some legs on gold. So I'm still not getting big there. I have I want to get much bigger in the dollar, as I think the signal, higher lows, higher highs in the risk ranges has a pretty good signal. But I'm just risk managing what we have right now.
Yeah, exactly. I think that go ahead.
No, I still do own 3.5% in total of duration, right? Actually, about 3%. I trimmed a little bit yesterday into the green day for duration. So I still do have a small little 3% position. I think it's 1%, 1%, 1% in along the curve from IEF to ZROZ. I know that's not a Hedgeye position. It's more like a placeholder, a wake me up, and I'm not going to get hurt on a 1% position in each of those. And I'll do some trading around it as well. But yeah.
Yeah, on the dollar, I mean, on last week's call, it really started to kind of break out, and I think we were around. It closed that day around 104 spot 104 spot 496 on the 22nd. So we're kind of right back where we were last week, maybe a hair below that at that 104 spot 337. But the risk range has, in my opinion, gotten significantly more bullish or stronger. So when we kind of say stronger signal strength, that's a massive higher low and a higher higher on a week over week basis. Almost 50, almost basically 50 cents on both sides of the equation there. So the low end of the risk range down to 103 spot 07, squarely, at the moment, squarely above that trend level. But we are still kind of below trade that. Again, that trade is stale. That the trade level I have goes back to December. So I'll see if I can get kind of update levels out of Keith on the Dixie. But that's to me, again, from like a risk management or portfolio management standpoint. There's a comment, and I'll kind of dive deeper into this on a beginner's guide on Friday. But the reason why Keith is kind of risk managing UUP a bit more aggressively here, even though it's I wouldn't say aggressively, but I mean because he was a buyer this morning, but I think he was and he bought more yesterday too. So I think he was a seller late last week or early this week, something like that. But basically, my point is that when you're kind of between those levels, or when something's kind of reconfirming its trend and really kind of getting back steam, you want to be a bit more kind of like touchy with it, right? You want to have it kind of incrementally both add and subtract to it on green days until it really starts to confirm. And so, Mitchell, I mean, of course, the way that you're, managing your gold position, I think is absolutely, dollar position is spot on in terms of kind of, it's bigger than min, but sort of a little bit less than mid. And I would suspect that's exactly kind of where Keith has it as well. Even though I don't know that for a fact, but I would suspect that's kind of where he's got it as well. And I think, this is a clear signal where it's getting stronger by the day, every day, day over day, week over week. It's really kind of putting in, again, I can't express it enough in terms of the dollar being one of the best looking assets out there in terms of pieces of inventory in your portfolio. But at the same time, that doesn't necessarily, again, it's all dependent on how you manage your portfolio, your process. But just because it's a strong signal doesn't mean that you're necessarily at your max position size until maybe you get, especially near the top end of the range. I mean, even today at 104 spot 38, where are we? 1 second, 104 spot 38, 38. I mean, it's kind of a fair. Sorry, I'm just doing the math real fast. You've got almost a fair fight upside downside at that 0.92 ish. So call it like 1% upside and 1.25 downside. So, it's sort of a fair fight right now, but certainly closer to the top end of the range. And you could have been a seller this morning on that, on like the move, and then maybe a buyer, in the late afternoon, right? So really just kind of depends on how you want to risk manage it. But the dollar certainly is a place where you want to figure out, the way that you want to handle it and how you want to have it in your portfolio. But it certainly should have be a key position player for the moment.
Yeah, I'd agree there too. This has been a very, I don't know. We all try to think about what Keith's actual position sizes are based upon Macro Pro. I mean, he's not shy. He tells us when he has time to tell us, and But I think he said the other day or something he had like 77 or 78% in cash.
76
there trying
76% cash and long only.
Yeah, so I'm sitting there trying to think.
That was yesterday. That was as of
you know,
yesterday
the
morning.
20.
So just to be clear, yep.
Yeah, so the 24%. I'm thinking, you know, how's he broken that up over these 12 names?
Yeah, yeah.
So I mean, obviously, it's, you know, we do the best we can. We try to take the little bits and pieces. You know, we try to fit pieces of the puzzle together, and then obviously fit it into our own process. So I'm gonna run with that the best I can, because there are certain things that he can do in his short account that I can't do, right? So I'm just going to try to adjust certain things based upon what I can do for certain client accounts.
Yeah, no, to be clear, that was his long only, just FYI, so that wasn't his long short. But yeah, that's
Correct.
and his comment was there is nowhere to go at the moment. So that's, I mean, his long list went, or his long only re-rank went from, I think at
Slashed.
one point it had 20. He said 20. I want to say it had 26. I'll have to get the actual number, but I thought it was closer almost to 30, like 26, 28. And now we're at 1, 2, 3, 4, 5, 6,
12.
7, 8, 9, 10, 11, 12. Yeah. If you
And you really can't count the first one.
yeah, the money market account doesn't really, I mean, it counts as like cash exposure, but yeah, that's where he's got 76% of that cash. But yeah, well, I shouldn't say that, but like that's likely where it is. But yeah, so I think that's really good. Yes, Jimmy, you got your hand up.
Robert, good
Hey,
afternoon,
buddy.
man. It's been a while.
Yes.
Just wanted to pop in and say hi. You know, I know you're working hard for Hedgeye. Excited about this new red light, green light product, right? Still got some questions about how to utilize that in addition to all the other signals. I'll save that, but just wanted to share a quick observation. You know, in the last couple of months, I've been building the business, working with a lot of educators here out west, and you know, there's so many people that work hard, make an honest living, make like 50K, and they're struggling just to save a few thousand. So for a lot of you guys who are Hedgeye Jedis, you get it. But if there's some retail degens like me, don't make the mistakes I made going into Quad4. Every dollar counts, you know? We're not out of the woods. It's really tempting to play the short squeezes, to look at these 5%, 10% gains, but really there'll be a time and place for it. You know, save your money, work hard, and accumulate, build, and then there'll be a time to push the chips in. So that's my PSA for everyone. But more so just a question to you about how do you utilize the red eye, green eye in addition to the other signals that you have?
Yeah, good question. So it's still pretty new. I mean, I think we published that on Thursday, Friday last week. So it's pretty simple. I mean, Keith kind of got into it a little bit on Twitter the other night. I think it was Monday night. In terms of like, don't overcomplicate it. It's just sort of a general, bigger picture signaling tool in terms of, listen, you know, green is buy, sell is red, and if it's snoozing, that Thunder Bay Bear is snoozing right now, then it's kind of like a neutral, you know, kind of just wait and watch type signal. So again, right now, the way that he's capturing it, or certainly the way that Keith is relaying it, is more in kind of like the tactical kind of, not necessarily intraday, but I'm sure it could be in terms of him shifting gears, you know, from the morning to the afternoon type thing. But right now, it's definitely much more kind of like that tactical kind of pivots where he's seeing kind of overbought, oversold type situations where, you know, if you're trading more on the intraday basis or kind of multi-day basis, it can be, you know, it can just be another little kind of tool in the toolbox along with everything else in terms of the risk ranges, that kind of stuff. Yeah. But
thank you for the clarification, because I think at first I thought it was something about like for people who can't touch their portfolios or they're just looking at their long only accounts. It seemed a lot more tactical than something that's meant to be like an ETF Pro product. But I appreciate that. I know a lot of people trade SPYs and whatnot.
Yeah. So listen, Jimmy, it may evolve over time, right? As we kind of like get feedback and that kind of thing. But so I can really only comment on the last sort of 4 days that Keith has had it in his toolbox to kind of deploy and convey that to you know, to everybody. You know, it's a free app, right? So it's like you can't really get too.
Oh, it's free.
Yeah,
I get it.
So it's like, you know,
nice.
so it's like you can't really get too nitty gritty on it, or again, that's why it's like pretty simple. I think that's why the Mucker's sort of reiterating, kind of keep it simple, don't overthink it. It's really just like an extra tool for him to kind of convey, pivot points, right? So
awesome, man. Let's plug away and have the rest of the earnings season.
Yeah, absolutely. No,
Hey,
yeah, go ahead, Mitchell. Or was that Tom?
Hey, this is
Hey,
Tom.
Sorry,
How you
buddy.
doing?
Yeah, no, go ahead, Tom. Yeah. What was yours?
No problem. Yeah. Hey, since you're talking about red eye, green eye, I've just seen a few references to that. I haven't really figured out what it is other than an app that goes green and red and I guess gray. Is that the S&P 500 that it's signaling on, or what's the market in general?
Hey, Tom, I'm so sorry. Dan Holland stepped in for a second. I got distracted. Could you repeat that question? I'm sorry, Tom.
Oh, no worries, no problem at all. So the app that you guys are talking about, the red, green,
Yeah, red eye, green eye. Yep.
yeah, is that just the S&P 500? Buy on green, sell on red.
That's correct.
Type of thing, or is
that's correct?
Okay,
That's correct.
okay,
Yep.
okay. Yeah, I'll have to download it and give it a look. See, I have another question. I've had
to be
actually
specific,
quite a while.
it's this. Yeah, it's the SPY, SPY.
Okay,
Yep.
okay, cool. Thanks.
Yep.
So I've been a subscriber. I've been using the risk ranges for a long time. It's very, very helpful. The one thing I don't quite get, and maybe I just don't understand it or whatever, but Keith provides, the SPX, the Russell, I forget which one that is, and then there's also the comp, which is the NASDAQ composite, which is the whole NASDAQ market. I don't know how to use that particular risk range, because if I look at Qs, that's the NASDAQ 100. If I look at futures, that's also the 100. There's not, as far as I can tell, there's not something that actually trades. You can't trade on the full composite. Is that correct? And my question is, how do you use that particular risk range when you want to trade an actual security on it?
So it's a proxy for the Qs, triple Qs. I know it's not.
Okay.
You're correct, where it's not specifically the Comp 100. Like that is
Right.
in trading view, the ticker I use is IXIC. And so, yes, that is correct, but that would be it's the Comp NASDAQ. I've always used that as a proxy for QQQ.
Okay.
Yeah.
I did that in the past too. I translated from the comp ranges and just translated to similar things on the Qs.
Yeah.
That works, but it's not exactly right on.
That is correct.
That is correct.
But I just don't think there's an ETF. At least listen. I got a pretty good knowledge of ETFs, Tom. I don't think there's an ETF that includes everything there. Again, like with these risk ranges, you can use the Comp Q as a proxy for the NASDAQ, and then overlay that with the, what I lovingly call the sexy seven, in terms of, where are they within their ranges, because they are a huge impact on the NASDAQ 100.
Right. Yeah.
Right.
So it might be useful, just a suggestion, it might be useful if we did something that was more directly investable, like the Qs or whatever the futures, be it the
I will share the feedback. But he's been doing CompQ for as long as I've been a subscriber. So I highly doubt. I'm pretty sure there's a reason for it that I'm just not sure of.
Okay. Yeah. So just some feedback from the little guy. So also, as you know, but maybe some of the people don't listen, I'm just an individual investor. I have a day job that's completely unrelated to anything to do with markets and investing or trading or anything. But I have been doing it on my own for a long time. Compared to what Mitchell was talking about, the big guys that are kind of locked in because they've got millions of dollars to trade. If they're the Carnival Cruise Line, I'm the guy on the jet ski. I can move around pretty darn quick if I have the time to watch the markets and move, and I use stops and stuff a lot for that too. So, but giving that background, if anybody's interested, so my position as a fairly small investor is half my retirement nest egg is now in short-term treasuries, like 1 year and less. We've talked a little bit about that in the past. And other than that, I'm pretty much flat, maybe 100 or 10% invested overnight, no in equities, no more than that. And then during the day, I might get up to 25%, depending on what opportunities I see and how much time I have to get involved. Some things that look with the dollar down, the commodities are actually up the past few days. I did pretty good with copper futures. I think it was yesterday, just for a quick trade. And then other than that, beyond the regular risk ranges and things that Hedgeye is talking about, I've found that in my own research, that dry bulk shipping seems to be getting interesting. There's this Baltic Exchange dry bulk index that's coming off its lows since about mid-February, and a lot of the shippers that are in that space are moving up, and I've been trading some of those pretty successfully. Things like Diana Shipping and Global Ship Lease, and I think there's Star Bulk that looks like it's good for a trade. So that's one thing that I've been doing when I have time. And then also the beer companies, Tap and Bud they keep coming up on my screen is something that looks interesting. And Keith actually mentioned it, I think, yesterday or maybe today on the call, and which is kind of interesting that I'm kind of in sync with him for a change as far as what my signals are telling me. So I don't know if anybody has any ideas on that. I haven't done anything with that information. I'm just kind of watching them right now. But that's kind of what I've got going on, and I'll just sit in the background unless anybody has any comments or questions for me.
No, it's awesome. Thanks. That's good stuff, Tom. I appreciate that. And for those
Thanks.
and for those that are curious, I did just retweet and put up in the Nest the Red Eye Green Eye app. There's a couple of links in there for both iTunes and Google Play. So if you're an Android or iTunes user, you can find it in there. But yeah, Mitchell, you were going to, I think, make a comment or something like that on either Red Eye Green Eye or something else. But the moment may have passed. I'm not sure. You're on mute if you're talking. All right, I'll take that as the moment has passed. So no problem. But all right, well, we've kind of covered a lot. Tom, you mentioned kind of commodities, energy. We did touch briefly on oil. Natty gas is another thing where maintains its bearish trend. It's had a kind of counter trend bounce here. Gold's putting in a higher high as of this morning. I think again, if you look at week over week basis. Definitely one that's opposite of what we have said, kind of like the dollar, right? On a week over week basis, that low end of the risk range has gone lower, so it's made lower low and a lower high on a week over week basis. So again, just be cognizant of these kind of week over week, day over day signals, where you are within the risk range. It's still bullish trend, so that's where you want to have your capital allocated to. But if something's kind of making a lower high on a kind of week over week basis, but a higher high on a day over day basis, that's kind of how you would tweak your capital, right? So rotating that portfolio, rotating positions, perhaps, taking some off the table as Keith did this morning, or maybe this afternoon actually is when he hit the RTA. I kind of lost track of time, to be perfectly frank with you. But whenever he hit that RTA, when was the GLD? GLD was this afternoon. So when he hit that button this afternoon, that's it's kind of like a rotation, right? So you can trim some in a bullish trend on gold, and you can add some of, say, the dollar on red, right? So just kind of think about that as you're rotating through the positions, and then also from a position sizing standpoint, something with the signal strength that's kind of weakening a little bit, or certainly putting in kind of a lower high on a week over week basis. You might not have gold at like your max level, and certainly if you have the re-ring product from Keith, it is not. It's at the top half of the list, but it's not his number 1 or 2 position size. So just keeping those all things in mind. Commodities certainly are, like many things, are kind of putting in the Quad4 playbook, and are showing some weakness there. But why don't we open things up to the floor? Those listening in, That's a Muni guy out there, Palmer, Eddie, Wasim, a lot of friendly faces. If anybody's got any questions or commentary, things we may have not hit on yet. I haven't quite gone into Europe, but I know Keith put out that first short back on the board inside of Europe. So definitely something he's been referring or alluding to and mentioning the last few days. The lower highs, certainly within the DAX risk range that we get on a daily basis, is a great proxy for generally Europe there. But keep that in mind as well. But anyway, we got Muni guy at on deck. How you doing, Brian?
Hey, how's it going, Robert?
Good, buddy.
I was just on the treadmill, and I got back from a conference when my employees put out an email. I tested positive, and so I've been banned to the basement. I tested positive too, but my doctor put me on this Paxlovid, and I feel like I'm on 5 prednisone packs. I probably could lift this house right now. Yeah, it's pretty. I am wired right now. I am wired.
Well, let's get that energy out through spaces, baby. Let's get those juices flowing. Talk about munis.
No. First, so I actually turned into the Disney bear at 110, and Disney's getting smoked. And I just got my annual email to renew our annual passes, and they went up 7%. And so I'm even more bearish because I really think that, just being a family that's a big Disney family, who've just priced themselves kind of out of the market. It's just literally too expensive. So it was kind of just an interesting email I got today. Of course, my wife's like, please renew, and I'm like, what? Like, whoa. So so I just throw that out there anecdotally. But on the positive side, The Mandalorian just got released today, so episode 1, little Baby Yoda action. So
I know you well enough, Brian, over the course of the last couple of years that I know you will be renewing that subscription.
Oh yeah. No, my wife will do it if I don't do it. So definitely. But so I put a bunch of tweets out today, and going over rates. And so today is SIFMA reset date, and we've been watching, and we've slowly come down, and then today we just really crashed downward. So we went from a 342 last Wednesday to a 280, which is a decline of 62 basis points. A little bit shocked, quite honestly, that it's came down this much. There's I put out on one of the tweets a bond that resets daily, and you can kind of follow the daily rate. And we've kind of monitored it. It seems to be a pretty good proxy to kind of where SIFMA is going to reset. So at a 280, leverage works in the muni space, which is why I follow it. And then at the same time, it's now 62% of SOFR, which, the benchmark should be right around 66%, give or take. It's kind of 2/3 because of the tax exemption. I would make the argument that SOFR is probably under right now because we're waiting for the next, Fed increase. And so that kind of takes me to the Fed. I think I've said before, I subscribe to Quill, and I follow Danielle's predictions on rates very closely. And she's very responsive to emails too. And so, we got Fed meetings on March 22nd, May 3rd, June 14th, and then July 26th. And her prediction is 25 bips until we get to July, and July is kind of the unknown. So what does that mean, right? That means that we could take Fed funds to a 550 and maybe a 575 on her as of today, kind of a high mark. And then, Powell's goal is to hold it there and just do this slow wrecking ball demolition with all these zombie companies and the labor market. So what does that mean if it goes to a 550? That means SOFR would move up to roughly a 530, which means SIFMA at 2/3 would level out at a 350. And at a 350, you can still run to leverage. in these muni bonds. And we've been tweeting out, and I know John jumped on last week, and we kind of talked about how a lot of these closed-end funds have just gotten their dividends whacked by anywhere from 15 to 25, 30%, depending on how much leverage they carry. And as much as I don't like funds, I also don't want to miss out on leverage. So this is not advice at all. This is just Brian personally. I did put an order in today. It did not get filled, but I put an order in today for a BlackRock 2037 target trust, 14 and a half years to maturity fund. The symbol is BMN. It is a sister to BTT. There's really not a lot of info out there. If you want to know what it holds, you got to go into the SEC's website and Edgar and go into the Edgar database and scroll through it. It's really, really new. So I think it's calibrated properly for today's leverage. So I'm actually going to dip my toe and buy a small position in BNN as a beginning starting point to kind of not miss the potential reversal of the leverage cycle. But that's just me personally. And then in the muni space, I didn't put it out there today, but in the bond buyer today, it talked about how February was one of the lowest supply months year over year in, I forget the duration, but it was an extremely long time. So, supply is really, really low in the muni space right now. Don't know if we'll see a pickup. My firm, we actually have a pretty robust year coming, but I don't know about the space in general. We're more local government than we are the larger transportation type authorities that issue $500 to $1 billion when they do big projects. So that's kind of what I'm seeing. I've received a few messages from the last call that I was on. I wasn't on last week, but the one before that, about it's okay not to play in Quad4. It's okay to be in cash and just scrape that 4 to 5% and just wait it out. And so some people asked me to reiterate that so it can be ingrained into folks. But I think with your comments about Keith being in 70-ish% cash in the long only account, I think that kind of speaks volumes as to the way that people kind of see the setup here. But definitely feels kind of bearish. Does feel like a little bit of a lack of liquidity out there right now. And it should be interesting times. Really good opportunity, I think, for people to learn and be positioned, going all the way back to when we kind of started the Quad4 cycle, and Mike Taylor got on and gave the whole, here are all these events that have to happen, and at the end is this euphoria of opportunities. Just make sure that you don't lose your Fed gifts, like Trend likes to say. And number two, make sure that you've got a plan in place to take care of buy great opportunities when they present themselves. So that's really all I got.
No, that's awesome. Hey, when in terms of the local governments, when would you or like what kind of projects? Is it more like building improvement and stuff like that?
Yeah,
Like
yeah, I think one of the things that we do that's very, very different and has been well received. We represent about 90% of the schools in South Carolina. Is that we put together larger programs where we have them look at their annual needs and then their more their major capital needs and bifurcate them out. And so they're issuing debt to take care of planned out needs on a kind of a programmatic basis. So we don't really see much of a drop off in terms of our issuance. It's very, very steady. And on the major construction, that's typically a bond referendum. We actually just passed a bunch of them. So we actually feel like it's going to be a very good thing for us to get to Q3, Q4 potential, recession really kind of hitting, labor market hitting, and being able to buy labor and commodities at really good prices. Our clients have a lot of cash still, and their tax bases are still expanding. We're getting their audits in right now, and it's looking really, really strong. So we're not seeing any pressure in the local government space, with the exception of someone that has maybe a poor management team. I think then you would see, a lack of preparedness and a lack of planning. But that's not too many of what we deal with. There's a whole other side of the muni space which gets a little more attention, which is the hospitals, the nursing homes, anything that's a toll road, the more economically sensitive, non-property tax backed type of credits. Those are the ones that I think are going to be, the ones that get more pressure as we move through the recession. The ones that are more property tax backed and have good management teams, they'll actually do well in a recession because, again, they'll be able to solve a lot of needs at great prices. Does that make sense?
It does, absolutely. No, thank you for that education. I appreciate that.
Sure.
It makes perfect sense.
Which is why, as a default to that, which is why when people ask me, what fund to buy, I don't like funds, but there's only one fund I actually like, and that's the MMIN. And it's because it is an insured municipal bond fund. And because it's insured, the insurance companies will only insure typically essential service, which is schools, water, sewer, electric, city, county type revenue projects that have an essential asset to them, not a strip mall. So again, essential service I think is a lot different than non-essential service. And I think when you look at funds in general, most of them, if not all of them except MMIN, like there is no fund that's just a general obligation bond fund or just a water and sewer fund. Like I have never been able to find one of those that exists. They all have, crap in there that I would not buy on an individual basis.
Yeah, no, that makes perfect sense. And again, not investment advice, but that was
nope.
Mike India November. Mike India November. He's mentioned that a number of times on here. So if you're hashtag paying attention, that would not be new to you, right? Right, New York.
That's
not
right.
New. Yeah, but
not advice.
Not advice, and not new information. But Mike India November. Awesome. Your commentary on sort of things getting interesting or feeling, I guess, fresh to the downside. What I will say to that, and just to kind of not necessarily be devil's advocate on the other side, because I'm not, because it's the S&P's in bearish trend, the Nasdaq's in bearish trend, the Russell's in bearish trend on the U.S. side of things. But we remain certainly on the VIX and the S&P still very much in the chop bucket, right? So, with the refresh risk range that we got late this afternoon on closing price on the SPX, again, no guarantee. That risk range is probably going to move slightly tomorrow. But there was a little over 2% upside and a little over 1% downside. So that's a 2-to-1 ratio to the upside, and the Thunder Bay Bear is snoozing. So again, just to kind of keep that in mind, right? There are kind of games within the game, and although things have been going in sort of the right direction over the last week plus for us sort of bears out there. But keep that in mind, right? We're still in the chop bucket. That 19.51 on the low side of the VIX is still very much a probable range. Just like that kind of almost 24 handle on the top side is a probable range. So it could kind of go in either direction here. And yeah, just want to kind of keep that in play. And really the reason why many listen to this call and the macro show and all the other kind of content that Hedgeye produces and the research is to be prepared on those moments where it is time to execute, right? So where to kind of load back up on the shorts or to perhaps add to some of the longs and that kind of thing. So just wanted to kind of say that again.
I think we all learned a lot in January.
We certainly did.
Yeah, and
at least
talking about
I'm a little less of
the
at least
risk
I'm a little
ranges.
less of a broken record, eh, bro?
Yeah, well, let me ask you a
Yeah,
question.
let's do it.
So risk
Yeah.
ranges. So Apple,
Yep.
right? So
Yep.
Apple started the year bearish trend, and through January, and went neutral, and then it went bullish, back to neutral, back to bearish. So tell me what your thoughts are on kind of Apple.
Yeah. So I think this is again kind of a key thing of like day over day. That's a higher low, higher high. I mean, incrementally. I mean, really, that's kind of like brownie motion, in my opinion. On that, going from 143 on the low side to 144 on top of the low end of the range. This is where I think looking at things week over week really can help put into again. If you go too much far back in time, those risk ranges kind of aren't as impactful because the dynamics, the price, volume, and volatility shift, right? So that if you go too back far in time, it's incorporating pricing and volume and volatility. That's no longer really in the look back window. So going on a week basis though, that's a relatively like flat, right? So it's basically it was 145 155 last week and 144 to 154 today. So to me that's it's bullish trend, but kind of it's a bit of a nothing burger right now. It's more of like hey, we've kind of gone from the top end of the range to the low end of the range, and let's see what let's see what kind of the risk range does in terms of moving and really putting in. Ideally, you want to see a lower high, right? And we're right there at 154. We're just inside the kind of 1 month and 3 month high, which was like 155. So that is a good first sign, but you really want to kind of see that top end of the risk range. Ideally, kind of really put in a lower high, right? Like sort of that 152 level, something like that. And that low end of the risk range to really start to move. Like today is a new closing. Sorry, it's not a closing 1 month low. We're getting close though. It still has pricing from. Yes, so it's got like end of January pricing, which was like 144.29. So, you're kind of right. You're right on the cusp of, but that's about to fall out of the look back. So the point is that you want to see that kind of lower high being put in where it's no longer, probabilistic range is no longer saying that it can kind of make a new high on a 1 month or 3 month basis. And then similarly, that lower low, putting in, showing you where there's a probable opportunity here that it's going to start to move lower and really pick up momentum to the downside. It is, I'd say, XOK and Apple are incredibly interesting to me in terms of ripe opportunities that had big runs, and you've had recent weakness. And on pops to lower highs, I'd be shorting them. I'd be shorting them aggressively.
Okay.
But right now it's like a wait and watch situation, especially at the low end of the range. It's like this: if you didn't have it on, like you're like, oh shit, I missed that. But like at the same time, you're likely going to get an opportunity, but you may have to be a bit more aggressive, right? If this stuff starts to really snowball on each other, and you get, which we've had over the last week, where these lower lows really start to kind of show up on the risk range day over day over day. And this morning, the refresh risk range at a big lower high. From a based on yesterday's close versus midday, that was a huge tell. A big lower high is a huge tell, especially in something that's had kind of a near term kind of non-trending kind of bounce higher like the S&P has.
Okay. Yeah. Well, two things I'm going to jump off. One, Rob's MPW space that he did either yesterday or the day before was just awesome.
Yeah, Monday. Unfortunately, it wasn't recorded. I went to go listen to it.
I
went to go listen to it. I was hoping
to listen to it again.
I was hoping to listen to it on the train this morning. I wasn't there.
Yeah, that was excellent, by the way. And the MPW story and the tweet telegram that got sent out to our buddy Brad, that was pretty special for those who haven't seen that on Twitter. And then I guess lastly, I know you guys have Danielle coming to Hedgeye Live again, and she's a good partner. She did an interview. It's on a podcast called Coffee and a Mike, and Mike is Mike. And she did a really good job of just giving like a really good macro overview of everything. And I just kind of recommend that people listen to it just to, kind of get a bird's eye view from her perspective of what's going on under the hood.
Yeah, no, that's she's great. She's done obviously a number of interviews here on Hedgeye TV. I put it in the tweet nest. I did include the snippet from the macro show this morning, where we do highlight the Hedgeye live event, which is May 4th, 5th, and 6th. It's our
Kentucky
premier,
Derby weekend. Yeah.
That's right, baby. It's our it's our premier event. So you go check it out. I think it's I was invited to it last year, and I was telling Palmer earlier today that it was certainly a life-changing moment for me to be able to go and have Hedgeye and pick up my ticket, and to be able to meet folks like Other Side Asset Management and Chris Moyer, 1000RFX, Leslie, Gavin, I mean the list, Trent Wizzo, we were able to meet him in person. I mean, just kind of being able to get to meet not only folks that we've interacted with numerous times on here, be as speakers or what have you, but also new faces and all that kind of stuff. It was just an absolutely phenomenal event. Learned a ton. You got great speakers like Danielle DiMartino Booth, and this year we've got Hugh Hendry coming, and I mean the list is Mike Taylor's back in the building. It's quite the great panel of guests on that Friday. And then to your point about Rob, you get you get a dinner with a sector head of your choice, and then breakout sessions with multiple different sectors on Saturday morning. So you get not only kind of great kind of industry leaders and thought leaders in the space, but then also get to sit down and get to dive deeper into certain sectors that you wish to learn more about. So it's a phenomenal event, all capped off with a huge, pretty damn big party. It was a hell of a party last year, and both Chris and I were hurting. Let's just put it that way. We had a 3.5-hour drive back to Boston airport. I dropped him off before he hopped on a British Airways flight, and we were hurting. We were hurting that drive.
Well, all right. Well, I'm going to jump off here. I see Mike
man.
Green Mike Green's listening in. So if he's got some time to jump up, that would be great to get his thoughts on the market.
That's awesome.
Thanks, guys.
No, appreciate it, buddy. So I did get a request or a comment about basically steepener, right? So with the 10 2-year spread being approximately minus 91, which I don't think that actually closed. I think it closed around where did it close today? Sorry, closed around minus 88, minus 0.88. But point is he was just kind of asking what positions asset classes could be impacted the most as it continues to steepen. And so I think what he was referring to is kind of widen. So really the short end of the curve versus the longer end of the curve tend to spread. And in terms of like if it expands, like it gets wider and moves higher, I think the lows in 81 were around, I think it got all the way down to like a 200 basis point spread at one point, but it might not have been 81. But point is in, it really depends on what's transpiring, right? So if like the 2-year on the short end of the curve, if it's really moving aggressively higher, or if it's the recession risk that's being priced in and the 10-year is starting to move lower, right? I think those are like two. So your question is kind of hard to ask, John, or kind of like really give you a straight answer, because it really just depends on what the actual movements are doing, or kind of how is that spread widening. And the long end of the curve most likely, or has a potential of starting to price in recession risk. So at the moment, it remains bullish trend in terms of the yield, which means it's moving higher. So all three of those components, the 2-year, the 10-year, and the 30-year, all remain bullish trend. And so again, those are kind of moving incrementally, so those are moving higher, the actual yield itself. So the signal is really going to guide you and we've talked about this a couple of times on here in terms of how you want to be positioned. So if that 10-year starts to break down and move back down to bearish trend, which we had about 2-3 weeks ago, and that's when we kind of initiated some exposure to IEF. I believe it was kind of end of January, early February, to IEF, and then TLT. you kind of want to gain some of that exposure from the long end of the curve in terms of just general fixed income. There are other components like the real rates, and this is one reason why we maintain our exposure to gold at the moment, is because real rates, gold really trades off of real rates, and with the 10-year or the longer end of the curve, if that starts to really move lower and to start to basically pick up momentum to the downside, then gold's going to act a lot better than it has in the last couple of days. Last couple of weeks. And the correlation, and this is where it was brought up yesterday afternoon, that US dollar correlation is one to kind of keep an eye on. So other side, and I think Jeff mentioned it, and you saw that today in terms of US dollar correlation to gold itself, shifted down to negative 0.9 from 0.91, but it was last week. That number was, again, kind of right around there. So it's a little Brownian motion, but negative 0.89 on the 15-day. But those 30, 90, 120 days, you would expect that to kind of start to kind of burn off a little bit. So in terms of where you'd want to position or asset classes to sort of be impacted the most, it's really going to be your long end of the curve, your 20-plus years, the TLTs, zeros, EDV, those kind of things would be probably from a fixed income standpoint, your best ETFs to express that. But there's going to be other exposures too, like gold and that kind of thing. Precious metals are going to work too. Chris, you jumped on. I know you kind of made a quick commentary. I don't know if that was.
No, I was just going to say probably the easiest way to describe it is Quad4, right? You don't need to make it any more complicated than that.
Yeah. Yeah, it's true.
Yeah, well, I was just going to say something, but I can see that he's in the list listening. But Michael Green kind of described it as the kind of is the steepening. The steepening, when the steepening hits in, that's the recession signal, right? It's
Yep.
Because that means that the Fed's kind of, well, whichever central bank, whichever curve you're looking at, it's kind of hit the oh shit and has to do something, right?
Exactly. Yeah, I mean, from a backtest standpoint, and again, these are relative because, and Chris has mentioned this many times, there's for every time that something's backtest positive, there's also the flip side of that where backtest is negative. But from a best asset classes in a Quad4 deflationary environment, it goes fixed income, gold, US dollar. So again, that's just kind of gives you an idea. If we do have proper Quad4 and those asset classes kind of work, or kind of work even more than they have certainly recently. Gold's still working, but the fixed income is not. That's going to be your kind of core three asset allocations, and one reason where many got kind of swept up seeing Quad4 and trying to front run the signal. So seeing Quad4 in late 2021, going into 2022, and wanting to get basically put on the traditional Quad4 playbook, which is dollar, gold, and TLT to use fixed income as an example, just to keep it simple. That certainly did not work all of 2022. At least the TLT certainly didn't, and gold had its moments in terms of the kind of the first kind of quarter and a half, if memory serves, on the GLD, and even UUP. It certainly ramped up into end of the summer and then started to roll over. So again, the Quad4 playbook just wasn't quite as traditional as you would have had. Yeah, gold peaked. What was it? Kind of early April, right? Wasn't it, Chris? Early April last year.
Yeah. So the end of March. Yeah.
End of March, right? Yeah. and then you really started to have the long end of the curve and short end, like it's just basically rates move significantly higher from there. So I think that was a telling sign.
Yeah. I know there's another guy jumped up. I don't know if he's got something to ask.
Yeah, I don't know. Jiro, did you have something?
Yeah. Hi there.
Yeah.
Because I think we all can agree that we're in Quad4, right? Where growth will deteriorate officially, and also inflation will come down, right? But I was just wondering if we might be a little too early to go long bonds. What I mean by that is we had the worst year in the history for global bonds, right? If we also look at the global aggregate index, the Bloomberg one, last year was by far the worst year ever. And so automatically, because we are thinking in terms of how do you say, of reverting back to the mean, right? So that this year must be a great year, right? And in January it looked like this, but year to date we are again negative actually in total return terms. So I was just wondering, because inflation will come down, as I said, but we actually only have until June, because then the base effects will be against us, right? Because the base effects currently, because of last year, to bring year-on-year inflation down, look good until June, right? But then the base effects actually stop. So basically, we could have another negative year for bonds, and also a lot of career risk, basically, right? So I was just wondering what you guys think, or maybe also Michael, how do you say, if you guys have an opinion on this?
I mean, I would agree.
Chris?
Like, I wouldn't be like, I'm not touching bonds. Just to clarify, like I trade just for myself, and coming into today, I only had 3 positions on, which was short the S&P, long the pound against the dollar, and short the pound against the dollar and long the pound against the Japanese yen. So I've got 97% cash. So I wouldn't be touching bonds. I agree. It's, Trent said it well last week. I said it coming into the start of 2022. Like, I don't run other people's money, so I can only talk from my own perspective. But coming out of this flat, Trent said it best. Like, stepping away, all of the free money that you got from the Fed, and all of the free wins that you got in whatever crazy crap you were long, the best thing to do is try and keep it. So coming out of this, we saw March, April, I guess last year, there was kind of this run up in bonds, and everyone's like, here we go, that's it, right? Everyone's good. Like you said, if it's career risk, if you're running money, you wait for the signal, whatever that signal, whether it's coming from Hedgeye or something of your own or whatever. It's not the time to be a hero for anything. It doesn't matter what it is. It doesn't matter which podcast you listen to where you thought, this girl or this guy sounds great, I'm going to go and buy whatever it is. Like, you just need to be comfortable with every decision that you make. So no matter how good it feels or bad it feels, it's like you said, career risk or personal risk is just don't fuck it up, because quad 2 is really easy, right? People can make plenty of mistakes, but in general, everything just goes up and you don't really have to do anything. So this is the time where you just don't fuck it up, right?
Yeah, I mean, listen, you've got elevated vol, especially in the fixed income space. So using Move as a proxy at 121, I mean that's a historically high level, right? And again, I mean, we hit kind of almost 160 back last year, and about the same level, but really only kind of took a cup of coffee up here, kind of looking at a 5-year look back in 2020. And it's been steadily above sort of the 100 line, going all the way back to to February of 2020. So that's when you got elevated vol across the board, that's a key sign within Hedgeye to sort of stay away and or kind of be very conscientious and cautious as to what how you're deploying your capital and when. And then you couple that with the signal, which, to your point, I don't know if I pronounced your name right, Jaru, but it's, you had the signal that kind of temporarily confirmed a pivot about a month or so ago, but then that broke down and reversed. And so that you've got those things also confirming, really at the end of the day, we kind of base our decisions off of the signal, and the signal is telling you to stay away, or at least short it, right? And so, that's it's really kind of as simple as that. Just waiting for confirmation. The trend line on US 10-year sorry, 1 second. Trend line US 10 years all the way down to like 3.62. So that low end of the risk range now at 3.77 is significantly, is well above that trend level. So as of right now, from a probabilistic range standpoint, on an immediate term basis, so on a daily basis, it's saying it's not, it's unlikely, or probably, again, these are probabilities, so it's probabilistically unlikely to break your trend level. So again, that's like a very telling sign, and one that echoes the fact that it is wait and watch, or take the opposite side of being long fixed income.
Yeah, because I thought, how do you say it? Because the levels are very attractive now, right? Because the 10-year almost at 4%, and if we look at long-term growth rates, maybe 2 or 2.5%, right? So that would be quite attractive, actually. But the problem is, when will we reach the 2% again, right? And so I'm just wondering, right, that 2023 might not be the year, actually, where it will go down towards 2%, right, the 10-year yield. So,
I think at the end of the day, really,
it's a tricky situation. Yeah, sorry?
Yeah, I mean, at the end of the day, I think it depends on your investment mandate, and depends on what you're trying to accomplish with your own portfolio allocation, right? So, I mean, some might say that, okay, my outlook is 5 years out or 10 years out from now, and so I'm just going to incrementally add, whatever, pick a level, anything above 3.90 on the 10-year, I'm going to kind of incrementally add to it and just build a position for a long-term allocation. I'm just making, just generalizing here, right? But then you've got others who, need to kind of get this right, or have a benchmark that they need to hit, et cetera, et cetera. And therefore, at the moment, you would want to be, maintain a short position here. And that really transpired over the last month, where you hit that lows of around, 3.40. And it just, it's basically been, as I said, up and to the right since then. So it broke back through trend, which was at that point in time resistance. Then it became support, and then broke trade, which again was resistance, and now is support. So you've got kind of multiple levels here where it is telling exactly what you just said, Giroux, which is this thing, again, until it breaks trade, that's the first opportunity to kind of get maybe interested. And then, once it breaks trend, you can reassess again. But, big tell is what's happening with the move and the volatility within that complex. So, I believe we're kind of saying the same thing, but right now, I would just, if you don't want to play the game, then stay away if you can. If you have to play it, or if you are interested in doing so, from a historical standpoint, I would say kind of who really cares what that level is, whether, because the game has changed at this point in time. The game is totally different. The Fed, all central banks across the globe are in a completely different place at the moment, and they have a 2% interest rate that is squarely in their sights. And we're nowhere near that really anywhere. And who knows what the potential Chinese impact could be on kind of demand. But your global demand at the moment is certainly trumping, and is certainly trumping that, and you're seeing that within the commodities complex. But it's certainly early days there, and I think in a couple of weeks we're going to have a much better, clearer picture as to what kind of commodity demand and what's the outlook there inside of the commodity complex, given a more robust sort of Chinese economy, and whether or not that can override anything that's happening globally in the weakening demand from Europe, US, et cetera, so the other G20 countries. But the 2% inflation is very much that's the bullseye for every central bank. I mean, I'm generalizing, but for the most part, and so until that's happening, and you're seeing that from the yield curves of the German 10-year is up 3.5% today, like that. I mean, that's absurd. I mean, that's a massive move in terms of the 10-year was relatively flat on the UK 10-year. Great British 10-year was relatively flat, but and the Japanese 10-year is kind of pinned at that 0.5 level, 0.498. So again, these moves are absolutely massive. The German 10-year is, I think, making maybe 12-year highs is what I saw last. Maybe not quite. Going all the way back to 2011. So 12-year highs. These are massive moves in the FX space. Sorry, fixed income space.
But if we look at today the ISM prices paid, right? So this effect will be felt maybe in 4 to 6 months, right? And this is exactly when the base effect turn actually against us. So that's actually also one of the worries, right? When actually inflation, we are at 6.4 year over year at the moment, right? And if we don't get at least towards 4% by then, right, or 4.5%, then I think we are in trouble.
Yeah, exactly. I mean, our nowcast, again, I can just speak to what our nowcast model is saying, and I don't have the updated. So from an inflation standpoint, end of the year, we're estimating, again, like I'm rounding it off, around just under 4%. So call it 3.8 is what our nowcast model is saying from an CPI year over year, U.S. headline CPI year over year projections. So again, that's going from, as you said, around 6 today down to basically shaving 200 basis points off of that number. Again, cool. I'm rounding things off, but yeah, you get the point.
yeah. But I have to say it's so interesting, right? Because the Fed is looking at at year over year headline CPI, whereas the Bank of England is actually using a more recent indicator, not a lagging indicator, right? They are looking at, okay, where will inflation be in 1 year, right? So I think it's very interesting that the Fed is choosing a lagging indicator, right? That also changes very, very slowly.
Yep. But that's been their. That's their whole transitory talk, right? As we were seeing real-time inflationary pricing happen in the actual market, and it took them 18 months to really start to clue in. So we're just in the early days phase of the opposite, except they're being very clear as to their goal of trying to combat inflation.
Narrative alert.
Sam's jumped up. How are you doing, man?
I'm doing good. Can you hear me?
Yes, sir.
Okay, you guys sound really well informed, and I wanted to ask a question. If anyone had been following what Russell Delaware, a few other people that I've run across online have been saying, that based on the amount of debt in the system, that governments are going to start sort of muscling central banks out of control of money, and run hotter than 4% range to nominally inflate GDP to kind of sort of run the debt off the books. They use some analogies from the late 40s after World War II. If you Google Russell Napier or Vincent Delaware, they both make some interesting cases that while they say they're going to run back to 2% and 2% is a target, we really haven't been able to keep it at 2% very much before QE and after QE. There's really not many years where 2% was accurately targeted and achieved. And so if you add that to the prior statements Mr. Delaware and Napier have said, if we are looking at a situation where governments, or because of emergencies or because of whatever monetary policies they might have, or fiscal policies they might have, they might be pushing more money into the system, there won't be the tightening that you think. Could we be looking at structurally higher inflations, structurally an end to sort of what bonds were for 40 years, and sort of a way to kind of get people to finance government debt, but at the same time, never really achieving a positive yield on their investment? Just some ideas I just wanted to put out there and ask the question.
I have no idea. I don't know.
I've met Russell, and he's a super interesting guy. And I did watch something recently of his, his kind of analogy of financial repression is stealing money from old people really slowly, which is kind of, I guess, what you're getting at. For me, it was kind of a flip comment, but it could happen. Like, just as anything could happen, and we'll end up seeing it in the prices. And there's nothing really else. Like, politicians will do what politicians do. So just look at the price, and the price will tell you. I know that's a bit of a shit answer, but
the interesting thing is that he, he's a economic historian, and he quoted some of what Arthur Burns said when they asked Arthur Burns why he couldn't get inflation under control. And basically, he used all of the government spending as an example to show that, this is the agenda. And I have listened to Mr. Napier, and I have read what he said. And I'm a work in progress. I'm trying to understand this. I'm just a retail investor, and every few months I come back to it, and I understand a little bit more. What he's saying is really so far out there that it might be right. One of the problems with sort of anticipating the future is if somebody tells you a future and it makes sense and it sort of seems to be a logical extension of the present, most likely not going to be the future. The future is something which is really out there. It's almost like fiction, like science fiction, which becomes reality in the future. And he's writing sort of a thesis, an idea of an economic future where governments sort of become much more proactive in monetary policy through their fiscal policies. And the bankers, the central bankers, aren't really going to be able to defy the will of the government. In many countries, the two things are very closely aligned, and they sort of toe the party line to a great extent. And so I read it again today, and it just blew me away, and it's really kept me away from a lot of bond investments that I've listened to people say, oh, well, you can get, 5%, you get 4%, you can get 5%. And I know people are playing on some money while and where they can see a trend and a pattern that can really lock in sort of long-term investment. But after reading it today, I just think that what we're looking at in the future, even though Mr. Powell is very adamant that he wants to bring it to 2%, I think that you'll just listen for language here and there from some of the Fed officers, the Fed people, and him mentioning that maybe a range would be acceptable. 4% was a reasonable victory for now. We could be looking at structural, and here's the thing. The long end of the bond market within the last 3 or 4 weeks, the futures have priced higher bond rates. Like a month ago, they were lower. I think somebody said they jumped by 70 basis points. The futures jumped in like 3 weeks. I mean, I'm not a bond person, but I think that's a big move. I don't think people can accept what's happening and what will be happening because, 40 years is a long time. That's a lot of educated, highly experienced investment finance people who don't remember what it was like in the 50s and the 60s. So you have to ask yourself a question. If we go back to that policy of government involvement, inflating away debt through increasing nominal GDP, if we go back to that, are we going to go back to a sideways stock market for a long time? How's it going to be different? That's just a thought.
Well, if the government's going to be handing out, going to be backstopping debt for companies, then you buy the companies. Like, I don't know what to say. Like, there's any number of things can and will happen. There's, and I'm breaking my own rule because I'm talking about a narrative. I can hear Robert laughing. Anything can and will happen, right? You just have to
Sam,
watch while it's going. That's...
So Sam, let me take this back on kind of how we think about things, right? So the signal here is going to be so we look at things on a trade trend and tail duration, right? So that would be 3 weeks or less, 3 months, 3 months or less, and then kind of 3 years or less. So, on those durations, right? That's where when Chris mentioned, the price is going to kind of influence and give you the signal. And so when we talk about signal, that's really what we're referring to, right? So the price volume volatility is our signal, or there's other components in there, but generally it's price volume volatility influence kind of our signal. And so going off of what you were commenting, and yeah, the 10-year, we'll just use the U.S. 10-year as an example. It's up about 60 basis points in the last month, which is about 14%. And then, but the move index of volatility inside of that complex is up almost 24%, or a little over 24%. So again, these are big moves. So you're absolutely correct. These are big moves in the FX in the fixed income world. And all of what you were saying there, and you mentioned that you're a retail investor. What I would recommend is it sounds like you're kind of spinning your wheels a little bit. Again, I'm not trying to be a dick or anything, but I think you're spinning your wheels in things that you have really no control over, in terms of kind of generally what we would call a narrative in this environment. I mean, I think we as, whether you're running $1 trillion or $1,000, you really have no control over what the Fed or what the Fed is going to do or the government itself. So I think you can really just build a process around what the signal is telling you and how you can implement that into your own portfolio. And at the moment, the signal is telling you to stay, not to be long, not only the short end of the curve but also the long end of the curve, because it's bullish trade and trend. So that's kind of the general answer there, or at least in my humble opinion. I think muni bond guy who just jumped back up, he has talked about kind of incorporating different fixed income exposures, certainly on the muni space, into your own portfolio in this environment. So I don't know if that's kind of what he's wanting to jump back up to do, because there are, again, everybody's risk parameters are different. So I think depending on your risk parameters, your how you risk manage your own portfolio, and really how what your process is built around, really will dictate how you play this current move in the in treasuries.
Yeah, Robert, what I wanted to say is really more, I think, that was all great in order to get back to the core, and that is the Hedgeye process is you build your own process. And, I'm between 50 and 51. I have a very different process than, Jimmy, who was on earlier. We're just at different life points. And the other thing that I heard was fear. And, that's normal, right? I mean, you're making decisions that are going to, affect the direction of your economic life, and you want to absorb as much information as possible, and you want to make, good, sound decisions, and you surround yourself around people that are trustworthy and accountable, which is why we like Hedgeye, number one, and why Hedgeye also brings in other folks that are experts in areas that Hedgeye may not be an expert in, which is why I mentioned Daniel DiMartino Booth earlier. And I think I'm not here to talk about what I believe muni bonds can do for someone and what they can't do for someone. I'm just here to get it back to the core, and that is you build your own process, and that's the beauty of the product and of all the tools and information that are made available to you.
Yeah, Chris, I'm going to have you send me that podcast because I had no idea who that person, or like not Sam, but I don't know. I clearly need to educate myself on some external narratives. But then again, maybe I don't. Maybe I just need to keep doing what I'm doing, which is focusing on the numbers and the data, because that's really what drives my process in our general process here at Hedgeye. So yeah, but it's always good to kind of have a listen on the train while you're running through some data, right, buddy?
Yeah, you got to get it done. But yeah, just while we're talking about recessions and everything, there's a load of crypto that's up like 20%. so yeah, they're not getting the fear. They've not got the Russell Napier fear, obviously.
They do not.
Chris, I'm glad you mentioned that. There's a lot of I participate in some discords, and we go back and forth on different things that we're seeing, and a lot of times I'll get a historical view of something, and it'll be, in 1940 this occurred, and one of my generic responses is, well, how did they handle Bitcoin back then? Mm-hmm. And the reason I do that is because we like to say every Quad4 is different, but I think that we're just in a different place today than we were in the past, and it's great to look at the past and find pieces that may be useful, but I don't think that it's 100% useful. I think that it's a new time, it's a different time.
Let's just hope. Let's just hope that's not a permanently high plateau comment. No, yeah. For me, all of the instruments are different, but it's still humans running around doing stupid shit with their money, right? So,
yeah, it's just a lot easier to do stupid shit.
Yeah. yeah. It's a lot easier to hit a button.
Right.
A lot easier to hit a button. You don't need to know a guy who knows a guy. But yes, in the on your comment there, darn it, Brian, I had a thought and now I've completely lost it. Oh, somebody tweeted about utilities, XLU, and kind of like why has that lost, or like again, it's not a bad question, but it is. It's just it is, right. So rather than asking kind of like why is it not working in Quad4 when it typically does, it just like do what it's doing. So like work in the game that you're doing. Now there are reasons for that, right? In terms of peak pricing, in terms of whether it be utilities, whether it be energy, coal, right, nat gas, what have you, right? Those pricing, those inflationary prices that they have been basically have been the beneficiaries of having over the course of the last 18 months are kind of rolling over. So again, there's like deeper reasonings behind that, and it's likely that you kind of see this in upcoming earnings. But this is where the beauty of the signal kind of front running, not just the quad, or the signal trumping the quad. So in a Quad4 environment, the XLUs are bearish. So really what you should focus on, to Chris's point, and to what Grant Percy said about bonds, which I'm going to actually just read because it's very spot on. Hedgeye process signal is long all rates, aka short bonds, and will be until the signal changes. And that's exactly right. So Utes are currently bearish trend, and until that changes, they are for all intents and purposes, a short. Or if you can't short, then it's just let them be and let them live and let them do their thing, and don't worry about it, and go look at inventory that can make you money, like ITA. So I think that's a good, it's probably a good way to wrap up, to be honest. You guys have anything else, Chris and Brian?
I just will part with, when you look at rates, there's two ways to look at them. There's a trade, and then there's buying an income stream. And when you get older, you need an income stream, and so I think you look at rates a little bit differently than when I was 20 years old. So when we talk about rates, I think you need to bifurcate in terms of your process. Whether you're buying rates as a trade or whether you're buying an income stream.
I think there was a CDO squared salesman that said that once. No, I'm joking. Sorry,
Appreciate that.
I'm a dick. I'm sorry.
Oh man, I love it. Awesome. Well, if you're new to this weekly notebook review, we host these every Wednesday afternoon, 4:30 p.m. Eastern. This is again, we kind of go through the premises of reviewing the data, right, in terms of the weekend work that we did over the weekend, and what we were expecting or looking for in terms of signals and confirmation and that kind of thing. Kind of taking a midweek review and assessing how things have pivoted, how bigger picture kind of larger full cycle asset allocations have either changed or adjusted, whether it be most recently along the dollar, or we've talked a lot about the treasuries, so U.S. treasuries, crude oil, et cetera, right? So kind of reviewing sort of how things are pivoting and how things have changed midweek, and how to prepare for next week, the week after, next month, next quarter, et cetera. So this is I certainly have a heck of a lot of fun hosting these. I know we get a ton of great speakers like Chris and Brian and many others like Other Side Asset Management, who was here earlier in the session, and Trent Wizzo, who couldn't make it today. But anyway, we get a lot of great speakers, and it's always a pleasure to host these. So thank you for listening in. If you want to catch the whole thing, you can catch it on via podcast and or the YouTube channel at Hedgeye. And if you enjoyed what you heard today and you want to learn more about our signals and quad outlook, et cetera, you can always go over to the hedgeye.com website and peruse along that. So with that, I hope everyone has a great afternoon and evening. Again, Hedgeye Live is happening May 4th to the 6th. Professor Mike Green, who's listening in, he will be in attendance and a panel speaker there at Hedgeye Live. Again, May 4th to the 6th in Stamford, Connecticut. The link's up in the nest. So I will leave it at that. Hope everyone has a great evening. Chris, thanks for joining us. It's getting to be almost, it's definitely your bedtime, eh, over there, 11 p.m.
Yeah, but I'm a bit buzzing because Arsenal beat Everton 4-0. So.
Oh, nice! I didn't see that. Oh boy, nice. Let's go Gunners! Hey, all right. Have a good one, everybody.